everyone needs to be aware of several significant changes to retirement accounts that Congress is about to pass. You stand to gain or lose a sizable amount of money once this takes effect. Not to mention that this is happening at a time when more than 50% of employers plan to eliminate jobs in the upcoming 6 months, and because of inflation, Gen Z and millennials will now need $3 million in retirement savings to live comfortably. Due to the likelihood that you will be impacted, we need to talk about the new proposed changes and what they mean for your retirement account, as well as the biggest risk to be aware of. Finally, we need to talk about how you can use this information to your advantage and make money. Welcome to the Financial Flow. Please like and subscribe to our channel and turn on notifications to stay up on our latest videos. First, we must identify the accounts that are impacted. The first is a traditional 401k. You contribute pre-tax funds to this employer-sponsored retirement account, and once you start taking funds out after the age of 59 and a half, you are taxed on them. This helps you save money up front, gives you more money after taxes to invest, and will save you a lot of money if you're already in a high tax bracket. Of course, the drawback is that even though you're not paying taxes right away, you will eventually, and you might be in a higher tax bracket by that time. Overall, though 401k plans can be a great option for many people because many employers match contributions dollar for dollar and provide a wide range of secure investment options. But that brings us to the second account, the Roth IRA, which is being impacted as well. Anyone can open this type of retirement account, which enables you to invest $6,000 per year after taxes. Once you reach the age of 59 and a half, all of the money you earn inside the account is tax-free. However, these accounts are primarily intended to assist regular Americans in saving for retirement. However, there are some rather significant changes that need to be made, so you should be aware of them. The Retirement Savings Modernization Act would enable 401ks to perform the improbable, which could result in huge gains or losses for investors in alternative assets. Millions of Americans will have access to higher returns and a more secure retirement thanks to this strategy and the quotation. If you're wondering which investments are permitted, they range from private equity to hedge funds to venture capital to businesses, real estate, etc. Even though this is only one change, we must discuss why some detractors are stating that this is going to be a major error, before going over all the other changes in this proposal. The first is that higher returns also entail greater risk. Even though the diversified portfolio performed better, the study only covered a period when interest rates and taxes were gradually reduced. It's unclear how well alternative assets will perform over the next 30 years, but in retrospect, that might have been the ideal circumstance for them to outperform. The second is that people who choose their own investments have terrible judgment. Investors could lose a sizable sum of money that they can't afford to risk losing because the average investor is so bad that they barely manage to outperform inflation. Alternative investments occasionally have higher fees. After all, the plan needs to be managed so that the fund can be rebalanced as needed, and that everything is running smoothly. Even though the returns could be higher, the amount that is ultimately returned to you might not be as high as you would anticipate. The likelihood of lawsuits is the fourth and main reason why this hasn't been made available in the past. The majority of people are unaware that in a 401k, the employer is obligated to provide the plans that are best for the employee, which typically entails providing the options that are least likely to result in a legal action. Of course, some claim that this is advantageous for investors because they could profit even more. From 1990 to 2016, the average portfolio increased by 17% as a result of investing in alternative assets, and they aren't the only ones who have noticed this. Another study discovered that, despite the sell-offs along the way, a traditional portfolio would have generated a cumulative return of 65% since 2014 with just a 5% allocation to Bitcoin. Additionally, a third study found that having alternative assets could help maintain portfolio balance during market downturns. You would have significantly more retirement option choices, which is another advantage. Traditional retirement accounts have a lot of limitations, which is one of their biggest drawbacks. By making them more flexible, you'll have a lot more control over how your money is invested. Finally, it equalizes the playing field for middle class and wealthy people. The problem is that, much like certain events, alternative investments have not been accessible unless you are self-employed and capable of developing your own plan. Working class Americans would therefore have access to the same investments as the wealthy if this was made available to everyone. There are many more changes that will soon be implemented, and they will probably directly affect your retirement. The first modification that the Congress wants to make for your retirement is automatic enrollment. Retirement accounts are currently optional, meaning that in order to make contributions, you must be aware of them and want one. However, if enrollment were made automatic, all employees would be enrolled without their consent unless they opted out. Larger tax credits comes next. You currently save the same amount as your tax bracket if you contribute to a 401k. However, this new proposal would automatically give 50% back up to the first $2,000, but it would be given as an investment back into your 401k. The wealthiest people currently benefit the most from contributions. The second is that, in certain situations, they would permit withdrawals without incurring penalties. A 10% fee is assessed if you withdraw your money early. However, you would have 3 years to put the money back in order to avoid paying any tax, and you could withdraw up to $1,000 annually for unanticipated financial emergencies. Then, catch-up contributions to Roth IRAs would be inflation indexed. People over 50 would be able to contribute an additional $1,000 annually, and this amount would rise each year after that based on CPI. Next, the number of 401k catch-up plans would also grow. Currently, those who are over 50 can make an additional $65,000 a year in contributions. However, this would introduce a new clause that enables those individuals to make an additional inflation index contribution of $1,000 per year on top of that. You need to be aware of the following. Okay, so to begin, we need to address this article, which now claims that Gen Z and millennials will need $3 million in retirement savings to live comfortably, which would translate to a yearly income of between $100,000 and $150,000. Everything is steadily becoming more expensive, so in 40 years, $1 million won't buy as much as it does now. For instance, $3,069,000 today would be equivalent to $1 million 40 years ago, and with that in mind, they assume that the majority of people will require significantly more savings than they might anticipate. Naturally, bear in mind that this would most likely occur in the year 2060, with the average worker saving just 10.5% of their income. Americans are simply not having enough for their retirement. There are mixed feelings about the new retirement changes from Congress, but I think it's admirable that there are more options and that the general public can purchase alternative assets. However, there are no assurances that they will keep succeeding, so staking your retirement on that is a little risky. They do not mention that there is no such thing as free money, despite the fact that their entire goal is to modernize retirement plans so they can offer diverse investments with higher returns. Due to the fact that higher returns also entail higher risk, allowing highly volatile, illiquid, and heavily managed investments could be a recipe for disaster if that person doesn't know what they're doing, given the performance of average investors. It is serious when people have no idea what is happening in their retirement accounts. And that's about it. Thanks for watching. Don't forget to leave a like and subscribe to our channel for more content like this. Have a good one.